So we are going to look at Chapter 2, and the first 3 or 4 minutes are going to be kind of review, but it may be things that we need to have reestablished. We're going to explain the steps in processing transactions. Now, we've been just putting the transactions, they've been telling us what they are, and we've been putting them into a worksheet. Now we're going to get a little more formal. And the first thing is the schematic of how you do this. First, you analyze each one of the transactions, decide what to do with it, then you record it, just like we've been doing, only we're going to formally record it in a journal, which means write it out. From there, they get posted to a general ledger, and from the general ledger, we create financial statements, or we analyze the balances in there. So this is a common process that we'll go over and over again throughout the accounting process. So we're going to look at an account. What in the heck is an account, and what are we talking about when we record it? Well, first let's describe what an account is. An account is simply a holding tank of the increases and decreases of a specific asset, as they say, or a liability or equity, or revenue and items. It's sort of like columns. You just have columns and you keep adding and decreasing. And when you get all done with the columns, you add them up and they should balance for assets equal liabilities equals owner's equity. And all those columns are contained in a general ledger. And the general ledger is where we keep those amounts and we pull off the amounts for the financial statement. Kind of looks like this. We have assets accounts. You can see we've got them all lined up here. We've got liability accounts and we've got equity accounts. And there's that old equation again. So each one of these compartments, boxes, however you wish to look at it, hold amounts of money that have been used in transactions for the business. And this is how we keep track of whether a business is doing well or not. Now, some of the accounts we have. Assets accounts are cash, receivables, notes, prepaids, supplies, land, building, equipment. Anything that we own that we can use is an asset. Then they move on and we look at liabilities. And liabilities are anything that's a payable, such as an accounts payable, a notes payable. Now, accrued liabilities and unearned income, unearned revenue. Accrued liabilities are liabilities we have that we haven't recorded yet, that just haven't made it to the transaction stream. And unearned revenue is revenue that somebody has paid us for doing a service that we haven't performed the service yet. Think of a lawyer, and lawyers get retainers for the year, and that money's not earned yet. So those are liabilities. And finally, you have the equity accounts. And we kind of lump this all together when we say owner's equity or stockholders' equity, but it's comprised of common stock, dividends, revenues, and expenses. And when you look at this, there's also retained earnings, which is the holder of prior year net income. So these make up your equity account. Now, if you go back, remember this one we looked at here? We're going to add to it now. Because we've just kind of thrown everything together in the equities account, we're going to define what is in that account. And that involves common stock, dividends, revenues, and expenses. So this has many more accounts attached to it than we originally talked about. And here are things that you need to know, and I don't care about this, I think you pretty well know that. Here are keywords, though, that I want you to look for. If it says prepaid, it's an asset. If it's a receivable, it's an asset. If it's a payable on the end of that account, it's a liability. And anything that says unearned is a liability. Also that accrued. If you see accrued expenses, accrued revenues, that is going to be, it's going to be on the right-hand side of the equation. Those are not assets, okay? So let's move down, and we're going to look at the ledger and chart of accounts. I'm not done much with this, but remember how I said that you could probably tell what an account was by the number in front of it? And I talked about ones and 100s and 1,000 and 10,000. Well, let's kind of look at this a little bit closer. Here you have cash all the way through equipment, and they're all in the 100 account numbers. Those are going to be assets. That could be 1,000, that could be 10,000, that could actually be 1. Okay, if it were in the 1 to 100 type thing, I guess. Or you could do 1.1, 1.2. Anything that begins with a 100 is usually going to be an asset. You could then look at all of your liabilities, which in this case there are 2, and they start with the 200 in the 200 level. I guess you could say this is the first level, this is the second level. And your equity accounts right here are usually in the 300 area. Your revenues move up to another level, which ends up being 400 level, or 400 at this time. And expenses are something that it's kind of at the whim of the accounting system, whatever. You could do a 700. I see a lot of 900 expense numbers, but they're always going to be your highest number here. So cash is usually in the hundreds, account payables are in the 200s, common stock, equity accounts are in the 300s, and your revenues are 400s, and then salaries in this case are going to be 600. So that kind of wraps up some of the things we've been talking about and a lot of the elements of accounting we've been working with. So we'll wrap this one up, and then we'll move on to journalizing and posting transactions.